Hello everyone, PS from PS Invest Plays here today. Starbucks is one of the few in its industry that has strengthened by the 2020 closures. It understands today's customers, has brand strength, and operates in a growing market. Since March 2020, Starbucks stock has more than doubled in price. Has the stock peaked? Or we can expect higher stock price in 2021 and beyond. In this video, we will understand its business, its financials, its future outlook, and review its charts using Elliott Wave to see how we can make money. So, stick around. I think you'll like what I have in store for you today. Starbucks Corporation, ticker SBUX. Starbucks Corporation is an American multinational chain of coffee houses and roastery reserves headquartered in Seattle, Washington. As the world's largest coffee house chain, Starbucks is seen to be the major representation of the United States' second wave of coffee culture. As of September 2020, the company had 32,660 stores in 83 countries, including 16,637 company-operated stores and 16,023 licensed stores. Of these stores, 18,354 were in the United States, Canada, and Latin America. Like other retailers, Starbucks suffered during 2020. It temporarily closed shops and reduced operations. Even today, sitting down in the cafe area isn't yet an option in some locations. Yet, in the quarter ended June 27th, Starbucks reported a 78% increase in consolidated net revenue to $7.5 billion. That's a record level for the company. And here's another record during the quarter. The company reported earnings per share of $1.01 on a non-GAAP basis. That's compared to a loss of 46 cents in 2020. Starbucks achieved this by adapting to today's customer. During 2020, Starbucks immediately moved towards contactless experiences and convenience for the customers. As part of a plan launched a year ago, the company is revamping its store portfolio to favor digital ordering and pickup in certain locations. Starbucks is opening smaller shops such as Starbucks pickup locations in cities and more drive-thrus where needed. And of course, Starbucks has made it easy to order ahead on its app. The effort is bearing fruit. In the recent earnings report, Starbucks said drive-thru and mobile ordering accounted for 47% and 26% of transactions respectively. So Starbucks is succeeding when it comes to logistics. But what about the actual coffee? The company is performing well there too. The key ingredient in this recipe is innovation plus customization. For example, Starbucks is making progress in the cold beverages category. Cold represented about 74% of beverage sales in the quarter. That's up 13 percentage points from the previous quarter. Why is this category so important? Because it adds to ticket and margin growth over time. And topping that off with customized options like espresso shots or dairy alternates is also pleasing customers. Starbucks Rewards program is growing rapidly, reaching over 24 million members at the end of the last quarter, up 25% from the end of 2020. It added more than 1 million in the most recent quarter. Starbucks' flagship product, coffee isn't one that will go out of fashion in the coming years. Global coffee sales total more than $400 billion today, and the forecast is for annual growth of more than 8% through 2025. Starbucks operates with a scale advantage unmatched by competitors. A sterling example can be found in the reverberations felt throughout the coffee industry when a frost cut coffee production in Brazil, the world's #1 producer. This followed a drought that struck Brazil's coffee farmers earlier this year. The combined weather events resulted in a severe drop in the projected harvest of Arabica beans. This resulted rise in costs, the biggest increase in coffee prices since 2014, will hit many of Starbucks' competitors hard, especially operators of independent coffee houses. Meanwhile, Starbucks is well prepared for the spike in price. Starbucks purchases green coffee 12 to 18 months in advance, and it never stopped buying green coffee throughout 2020 and 2021. So as a result, it currently has over 14 months of price forward coverage, which means its price is locked for the next 14 months, which gets it through the rest of fiscal year 2021 and most of fiscal year 2022. Starbucks is only large buyer of green coffee that uses this approach, and it gives Starbucks a significant advantage relative to its competitors, who, if they don't buy this far in advance, will certainly not have that cost structure. On top of the increase in the price of coffee beans, there has also been a spike in transport costs. This translates into headwinds that smaller operators may not survive, and at the same time, it creates a long-term opportunity for Starbucks. Total revenue from China increased by 23% over the last 2 years. China and the US account for nearly 2/3 of the firm's global footprint, with China viewed as a major source of growth. With 1,100 new locations planned for fiscal year 2021, 600 will be opened in China. That will bring the number of stores in China to about 6,000. Roughly half the number operating in the US. Looking over the long term, with just under 33,000 Starbucks locations worldwide, the company has plans to open 55,000 stores by 2030. Last week's news where Yum China reported slowdown was overblown, and it resulted in Starbucks stock losing 5% in a day. I think it was knee-jerk reaction and you should ignore. Starbucks 2020 revenue represented roughly 9% of the aggregate cafe and bar market worldwide, with Dunkin' Donuts a distant second with 3% of the market. Consequently, it is reasonable to believe Starbucks has ample room for expansion. Looking at the financials for Starbucks, revenue, gross profit, EBITDA, net income, earnings per share EPS are looking excellent. And when you compare the numbers with 2019 numbers, they have increased by a good clip. Starbucks dividend for its common shares now stands at 45 cents per share quarterly, or $1.80 per year. At its current price, that amounts to a cash return of 1.5%. To put the payout into perspective, the average dividend yield for the S&P 500 is 1.3%. Starbucks has been paying dividends since 2010 and is also increasing them yearly. It did not cut its dividend in 2020. Instead, it increased it, which is remarkable. In the chart on the right, free cash flow, FCF, currently stands at $3.92 per share. It is improving with every quarter. since dropping to negative territory in early 2020. In the chart on the left, price to earnings ratio PE currently stands at 43.34. The PE ratio is trending slightly higher than the historical average. Starbucks has a long growth runway. The company is expanding at a steady pace while most of its competitors are struggling. The current surge in coffee prices that represents a major headwind for smaller operators will likely work to Starbucks' advantage due to the company's hedging of coffee supplies. It has a well-funded, rapidly growing dividend and a firm financial foundation. While Starbucks has a commanding position in the US, it only serves 1% of the market overseas. This presents an enormous growth opportunity. All in all, the future for the stock appears bright. This is also indicative in the charts where I see the stock price to increase considerably in the next 3 to 5 years. If you like this video, please don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. Looking at the charts for Starbucks, the bull wave that started way back in 1990s is still not over. It has completed its first 4 waves and now it is in wave 5, super cycle wave 5. If we look deeper in this wave 5, we can see that it has completed its first 3 waves. Wave 4 pullback is currently underway and I expect a 38.2% retracement of wave 3, giving us a price target of around $102.62. I expect a strong resistance around $105 and support around $99. This to me is an excellent entry point or entry range. After this retracement is completed, I expect the final leg up, which is wave 5, to resume, which typically is an inverse 61.8% of waves 1 to 3, giving us a price target of $178.49, which translates into a 77% profit in the next 3 to 5 years. Now, let's summarize. As I said earlier, at current price levels, nibble any pullbacks and accumulate corrections. The range between $100 and $107 is an excellent buy range. I would recommend to hold it for at least 3 to 5 years, as I expect the price target to be around $178.49, which translates into a 77% profit, and the icing on the cake is that it pays $1.80 per year as dividend, which is a 1.5% dividend yield. What do you think of this analysis? Please leave me a comment and let me know. As always, please don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. Until then, bye-bye.